Accrued expenses is an accounting term for money your business owes because you have not paid for the expense yet and you haven't received a bill for it either. Let's explore an example of accrued expenses to better understand the term. Let's say you're the accountant for a cafe and it's time to finalize the accounts for January. When reviewing the draft income statement, you can see that nothing has been included in repairs and maintenance, so it looks like no repairs were done to the equipment during the month. But this is not correct. What actually happened in January is the coffee machine had its annual service, but the maintenance company had not yet sent you the bill. Because no bill was entered into the accounting system for January, no expenses were posted to the repairs and maintenance line on the income statement. As the accountant, you know that all you need to do to fix this problem is accrue the expense by posting an adjusting journal into the accounting system. To work out how much to accrue, you check the quote that was signed by the manager of the cafe and see that the quoted price was $500. After checking with the manager to make sure that no other work was carried out, you decide that $500 is the right amount to accrue for this expense. You then post a manual journal in the accounting system on the 31st of January, being the last day of the month, that looks like this: a $500 debit to repairs and maintenance and a $500 credit to accrued expenses. After posting the journal, you review January's income statement again to see that $500 of repairs and maintenance has now been included as an expense. The income statement now represents the true picture of how the business performed in January, with $100,000 of revenue generated against $90,000 of expenses, including $500 of repairs and maintenance, leaving a profit of $10,000. You then review your balance sheet as at 31st of January to see that the $500 has been added to the accrued expenses line. Because the accrued expenses account represents costs you have incurred but have not yet paid, it sits in the current liabilities section of the balance sheet along with accounts payable. Just like the income statement, the balance sheet now represents the true picture of the business at the end of January. Accounts payable has a balance of $12,500, which is the total of all unpaid bills currently in the accounting system, while accrued expenses shows $500 of costs incurred but not yet paid for which no bills have been received. After reviewing your income statement and balance sheet, you conclude that you have successfully added $500 of accrued expenses to the accounts for January. Now let's take a look at what happens to the accounts in February. Sometime in February, you'll receive a bill for $500 from the maintenance company and enter it into your accounting system. But when the bill is entered, the accounting system will automatically add $500 to the balance of accounts payable on February's balance sheet. It will also add $500 to repairs and maintenance in February's income statement, making it look like the business incurred $1,000 worth of expenses across January and February. This, of course, is incorrect, as the total amount of repairs and maintenance expense incurred over the 2 months should only be $500. You know that this is easily fixed, and that all you need to do is post a journal in February to reverse the journal posted in January. This can be done in one of two ways. In some accounting systems, you can set up adjusting journals so that they automatically reverse the following period. This saves you from having to do it manually. But if your system doesn't allow for this, or you just want to do it yourself, you need to manually post the reversing journal. Either way, the reversing journal is going to be the exact opposite to the original journal, except that it is going to be posted in February and not in January, and it will look like this: a debit to accrued expenses of $500 and a credit to repairs and maintenance of $500. At this stage, it's worth pointing out that although the reversing journal was posted on the first day of February, it could have been posted on any day of the month. That said, it's customary to post adjusting journals on either the first day or last day of the period. After the adjusting journal has been posted, the income statement will correctly show that over the 2 months, the business incurred $500 of repairs and maintenance expense. And February's balance sheet correctly shows that there is nothing in accrued expenses, because there are no longer any expenses on the system for which you haven't received a bill. Instead, the business owes an unpaid bill of $500, which is why that amount is now in accounts payable. Now let's see what happens to the accounts in March when you pay the bill. When the bill is paid, your accounting system will automatically credit cash at bank by $500 and debit accounts payable by $500. Your income statement will still show that the business incurred $500 of repairs and maintenance expenses in January and nothing in February. This is an accurate representation of how the business performed during those months. As for the March balance sheet, it will show that the business does not owe any money from either accrued expenses or accounts payable for this particular expense, and it will show that cash at bank has been reduced by $500 to pay for the bill. So that's how you can use accrued expenses to ensure that the income statement for your business shows the correct amount of costs incurred each period, rather than how much money you have been billed or how much cash you have paid to suppliers. And this helps to ensure that your financial statements accurately represent the true picture of how your business is performing each period.